Alex Crooke, Fund Manager of the Bankers Investment Trust. Now, there seems a bit of movement in the UK weighting recently. Where are you in this regard?
So we've reduced the UK exposures modestly, back under 40% of the trust. And we've been essentially selling some of the defensive stocks in the UK that we just feel are overpriced. They're very expensive within the pharmaceutical sector, within some of the utilities. So we think those stocks have done as much as they will, and we'd like to reinvest those proceeds into either other markets or within the UK.
Now, Europe, we've had Mario Draghi's announcement of QE, and in October, November time, you increased gearing there. So how has this played out?
Yeah, so the market fell quite sharply in the middle of October, and we used that opportunity to invest a little bit more of our gearing, so we borrowed some money, invested in the market, which has worked out quite well. We actually bought quite a lot of Switzerland, which is the currency has been the predominant gainer on that, but it's again a good move has been made there. So we haven't really sort of fully allocated to Europe in any sense yet, and I think what we're going to see from the ECB is slow and gradual recovery in markets. So their process is to keep investing, keep buying bonds until we get economic growth and activity picking up. Now, we think that will take a year or two really to get really going. So I think we've got time within the European portfolio to really focus down and find the right stocks which will benefit from that environment and see how much traction it gets as well in the shorter term. So we have made some modest increases. We will probably make some more, but we'll bide our time, I think.
Okay, some of the portfolio is invested in emerging markets, which seems a bit weak, especially considering the strong dollar. So what's the trust's approach here?
Well, again, it's twofold here. We prefer often to invest in listed companies in the West that feed into growth in emerging markets. And we can do this. So in the UK portfolio, we have, say, two stocks. Examples, we have one that's a South African investment that owns media and building products in South Africa, but it's listed in London. So we have a little bit more security of the corporate governance of the accounting, etc. Other ways we can do things is to invest directly, and so for instance in China we own direct securities in China. We bought those on very, very cheap ratings, and the performance has been very strong. Outside of China, I think we're a bit more cautious still, that commodities play an important part in many economies, whether it's in Latin America, South Africa as well. And I think again, seeing how that plays out, and the value of the dollar has appreciated as well, which again has challenges to these markets. So I think we're a cautious approach outside China, and actually trying to own stocks where we have a little bit more security of ownership.
Okay, finally, Alex, the trust has around a 2 times dividend cover and has received a number of specials recently. So do you think a special dividend is possible?
We will see. I think the strategy has always been to consistently grow the dividend. We have a record going back to 1966 in terms of every year growing the dividend. And I think that's our primary objective, is to maintain for the future generations that consistency and growth. If we have a very high level of specials, then we will review the cover and how much reserves we hold. But I think that's still a little bit further away from here. Our policy is predominantly to pay out all the income we receive, and therefore actually the reserves cover will fall over time as we grow the dividend and maybe not add to those reserves. But the outlook for dividends is still very strong. We're finding good growth in many companies paying out a larger proportion of their earnings in dividends, which is also helping us. So I think we still have a very firm positive outlook on dividend growth going forward.
Alex Crooke, thank you.
Thank you.